list of all the auction facilities and discount loans. Do these moves, plus cutting the Fed funds rate, remove what people call systemic risk, or at least reduce systemic risk from the bad bonds, the bad mortgage securities, the bad collateralized debt? Here's a little quick primer. The various auctions and discount windows, $200 billion to the dealers, $100 billion up on auction, $100 billion on repo, $36 billion in swaps, $30 billion to Bear Stearns, which I think is now $29 billion, $13 billion going to dealers. And actually, of the Fed's balance sheet, which is close to $900 billion, the Fed has now pledged roughly half of it, Don, in forms of collateral and other forms of liquidity. Now, that seems like a lot of action for a government agency. Is it worth it? Are we seeing a shift now and fewer worries about something called systemic risk in the banking system?
Look, that's what the Fed was created to do. The Fed is in the bailout business. The Fed is in the business of backstopping against systemic risk. It's not in the business of saving individual banks or equity holders in individual banks. Nobody at Bear Stearns was bailed out. Everyone at Bear Stearns was wiped out. What was bailed out was the system. Because after 9 months of this credit crisis, the Fed has finally figured out the right tools to use and put enough power behind them. Just as you said earlier, they should have opened the discount window to primary dealers, not banks, back in 1999 when Glass-Steagall was repealed. It's unconscionable that it took a decade to figure out the right thing, and especially these last 9 months of torture to figure it out. But they finally did. So, yes, systemic risk has been completely eliminated. Mission accomplished. Let's move on.
I guess what I'm hearing Dick Beauvais say is that we really need to look more closely at cash flow even when valuing banks.
Well, there you go.
All that's true, but the primary asset of any of these firms is confidence in the marketplace. And when a rumor gets started and confidence starts getting eroded, it's like a snowball rolling downhill. It gets bigger and bigger and faster, and pretty soon a $20 billion company becomes a zero company.
All right, but
it
Don,
can happen to anybody. It
agree.
happened to Bear Stearns.
Don, you and I agree on that one for once, because when your leverage as Bear was 33 to 1, hey, it doesn't make any difference how much capital you have. You're leveraged at 33 times, and if you don't have the confidence and other people want their money back, you're in trouble.
Of course, the Fed can supply some confidence. Don Luskin, 1984, Cotton, Illinois, down. 1990, Drexel Burnham, junk bonds, etc., down. 1994, Kidder Peabody, down. That's somewhat akin to Bear Stearns. 1998, long-term capital management, down. In each and every case, Don Luskin, stocks rallied big time. Is it happening again in the wake of the Bear Stearns failure?
You know, remember that James Bond movie, You Only Live Twice? The first time when you're born and the second time when you look death in the face? We looked death in the face a week ago when the market opened and Bear Stearns was worth zero, and we had to ask ourselves, hey, what's anything worth? We looked into the mouth of hell. We had a choice of jumping in. We decided not to. This bull market has been born again. There's still problems in the macroeconomy, but all the worst-case risks are off the table. It's time to go in and buy junk bonds. It's time to go in and buy leveraged loans. It's time to go in and buy mortgage-backed securities. It's time to buy financials. All the stuff that got thrown out like babies with the bathwater. We've been born again. It's time to take risks again, folks.
This is the season for born again. Some would call it resurrection. Gentlemen, thank you. Hang on. Andrew Luskin, I think prices do matter. And I want to go to this point. All the resets, Don. Look, going from 5.25% to 2%, which is where I think the Fed funds rate is going to wind up. I see it in my mortgage. My wife and I look at it every month. We've had a huge savings. In fact, I did some back-of-the-envelope calculating, Don. The median mortgage, which is now just under $200,000, let's say you put 10% equity in. Let's just suppose, and you had an adjustable rate. The Fed has delivered you an extra savings of $300 a month or $3,600 a year, which is 3 times that crummy $1,200 rebate that's coming out of Washington, Don. To me, Bernanke is giving his own rebate, and as prices adjust and affordability rises, it may be a story that comes back faster. That is, if you believe in markets, Don.
Well, I do believe in markets, but I have to say I am of two minds about what you've just said. On the one hand, I think it's every time everybody talks about resets, what are they always talking about? They're talking about subprime loans that reset higher. And all these people are going to go into foreclosure and not being able to buy a pair of skis at Walmart this winter because of their resets, their resets, their resets. But you're talking about the reality, where the vast majority of mortgage holders who have adjustable rate mortgages are getting positive incremental cash flow as a result of their resets.
Huge.
That's the
Big
reality.
Numbers, by the way.
Huge numbers, huge numbers. However, I said I was of two minds. That's the good part. The bad part is that in simple cash flow terms, you know, one man's gain is another man's loss. There's some financial institution that's going to collect less money because rates have gone down. So there's a lender who gets less and a borrower who gets more. It's kind of a zero-sum game in a way. So I'm of two minds.
Well, but that's enough. Long-term investing in particular is one of my favorite approaches and themes. But Don Luskin, you have just written, hot off the press for everybody, gold down, inflation expectations down, expected inflation no more. What are you saying
look,
here?
I was there first saying gold 1,000. I was there first saying oil 110. We achieved all my price objectives. It's a done deal. The Fed, by daring to disappoint market expectations and cutting by 75 instead of 100, and then the market not punishing him for that, but the market rallying when he did that, and interest and rate cut expectations coming in even further after he did it, rather than widening as they had in all of the past cuts during this credit crisis. That tells you that the worst-case inflation scenario is over, that all these other new liquidity facilities of the Fed can now substitute for further cuts in the Fed funds rate. I think we may well not get another cut at all in the funds rate.
Gary Schilling, no more rate cuts. Interest rates have bottomed. Gold has peaked. This is big stuff from Brother Luskin. You're going to get the final word.
Well, you've had two remaining bubbles. One is in commodities, and the other has been in foreign currencies. And it looks to us like they're both breaking. And a lot of it is because a lot of people are being pressed. They're losing money elsewhere. They're highly leveraged. This is part of the grand deleveraging process which is going on. And in our view, it has a long way to run.
Where would you invest right now?
Pardon me?
Where would you invest right now?
I like long the dollar. I like short commodities. I like short China because that's the least understood in terms of its vulnerability.
Don Luskin, he agrees with you. Listen to this. He agrees with you.
Wow.
Well, I'm going to Singapore tonight, and I'm getting close there. But I think China is way overrated. And everybody believes they're going to grow independent of the U.S. They're not. They don't have big enough middle class.
Does this Schilling agreement and accommodation trouble you,
We're
Don?
both in trouble.
Look, I don't care when people agree with me for the wrong reasons. That still makes me a contrarian.
All right, we got to leave it there. Thank you.